Welcome to a quick webinar on the CARES Act and its impact on retirement accounts. My name is Justin Rucci, and I am joined by Emily Belmages.
Hi, everyone. I'm Emily Belmages, a certified financial planner, and look forward to talking to you today.
Very good. Before we get started, we do just have a quick disclosure. If you are interested in obtaining a copy of our Form ADV, you can give us a call on our main phone number listed on the top line there, 714-876-6200. To start, I'll cover the main two changes that took place as part of this CARES Act. It applies to both IRA accounts and 401k accounts. The main idea here is to essentially make distributions easier, specifically for individuals who are either still working or for individuals who may be retired a little bit early prior to the IRS retirement age of 59 and a half. The CARES Act basically removes the early 10% withdrawal penalty for up to $100,000 of distributions if you wanted to take that from either an IRA or a 401k. You have some additional flexibility in how this distribution is either taxed or potentially even repaid into the account. So if you took a $100,000 distribution from your IRA, for example, you have the ability to either repay that account into the account and pay no tax on it at all, and you have basically a 3-year time period to be able to do that. Or you also have the ability, if you want to keep the money, to have that tax on that distribution spread over a 3-year time period. It's important to note that while in most cases, spreading it over a 3-year time period will save you money in taxes, not always the case if 2020 is an outlier year and maybe this year's income is substantially lower than what you expect going forward. It may actually make sense just to pay it all in 1 year and have the tax paid this year. For 401ks specifically, you have the ability to take a loan rather than a distribution if you prefer. Typically, a 401k loan is capped at either $50,000 or 50% of the account balance, the lesser of the two. This law now changes that to a maximum loan of $100,000 and up to 100% of your vested account balance. To qualify for any of these options, you have to have been impacted by the COVID-19 virus, which includes a couple of different things that we'll cover in a couple slides, but in general, it includes basically being either financially impacted or actually being diagnosed with the virus. The most important thing I want to mention on this slide is just because these options are available does not mean that you should be using them. They're really designed to help people who are in a tough spot and maybe don't have any other option. So be sure to reach out to us if it's something that you're considering looking at. I'm going to pass it back to Emily. She's going to go over the changes to required minimum distributions that took place as part of the CARES Act.
Okay, hi everyone. So for our clients in their 70s or our clients who have inherited IRAs, RMDs have been completely waived for 2020. So it is case by case, but in most cases, it will make sense to skip your RMD for 2020. This will allow you to reduce 2020 tax liability as well as allow your retirement savings to stay invested. Now, if you've already drawn full RMD or partial RMD funds, there are options to roll it back into your IRA account. And as long as you withdrew the funds after February 1st, you can utilize what's called a 60-day rollover to roll the funds back into your IRA account, and you have until July 15th. To process that rollover. There are some eligibility requirements, and so we would walk you through both the eligibility and logistics of doing so. This, however, does not apply to inherited IRAs. So any RMD funds that have been withdrawn from inherited IRAs are a done deal. But again, in those cases, reach out to us as well, and we'll just help you kind of look at the big picture and strategize as to 2020 options and, of course, long-term options as well.
To piggyback off of the eligibility requirements from a couple slides ago that I mentioned here, we've provided some examples of what being impacted by the virus really means. It is somewhat flexible and open-ended in the way that the law is written, but we provided some examples just to give you an idea of what you will need to self-certify in order to take one of these types of distributions. The self-certification does not have a clear answer as to whether these will be audited or what the enforcement on this will be. We just know that in order to qualify one of these distributions, you have to essentially certify that one of these items applies to you. It includes being diagnosed with the virus by a test approved by the CDC, or having a spouse, dependent, household member diagnosed with the virus. And the much more open piece of this is just having some type of financial impact by the virus, whether it is being quarantined, being furloughed, laid off, having work hours reduced, and being unable to work due to lack of childcare or other reasons. It's pretty open-ended as to what the adverse financial consequences really mean in being impacted by the virus. If you think that one of these items applies to you and you are in need of a distribution from your account, again, I encourage you to reach out to us. We'll talk through the specifics and logistics and see if it makes sense for your situation, as many times these distributions might not be the best interest of what you're trying to accomplish, but it is an option, so it's important to know what all your options are. Lastly here, wanted to put our contact information up on the screen. As we've mentioned, we're available to talk through all of these things. It is a very case-by-case specific type of decision, so you want to make sure you're weighing all the different decision factors before you take any action. So we have both our phone numbers and email addresses on the screen. We're available by either. So if you're thinking about taking these distributions, be sure to reach out to us, and thank you very much for watching.